Goldman just came out with the infrastructure bill saying that it could be $4 trillion and $2 trillion of that is infrastructure. And they're going to use budget reconciliation, which means they're only going to need 51 votes, which they have, in order to pass this. And he believes, Goldman believes that's going to happen next year. So we're already talking, we just passed 1.9 trillion. We're already talking about the next one. I mean, pretty crazy, right?
Yeah. I mean, that's the Gunlock bond manager that we've talked about often had a great saying, it's expected now. People are going to expect stimulus as a permanent thing. And the market is going to continue to expect more infrastructures or other bills, and infrastructure is going to be the next one. The interesting thing that's going to pop out is once negotiations start and headlines start coming around, is the spending is going to be a lot less impactful in the short term than the recent coronavirus bill. Frank, I'd like your thoughts on that, because if they pass $4 trillion, obviously they can't spend it all in the first year. It's going to be spread out. And the reaction of the market, depending on what's in there in the early years, is going to give investors, I think, a real good heads up. So infrastructure is obviously on there, some green energy, ESG, the environmental, social, geopolitical, or governance, or whatever the hell the G stands for in that. But that's what really jumped out at me, is the spending and the size.
Yeah, the spending and the size. I'm going through the Goldman report too, guys. We have access to things like this, just showing it to you. I thought the report was interesting. I mean, you're looking at the amount of spending, and they're saying that it could be offset a little bit, though. They had a couple of things they were saying, which I thought were interesting. President say decided to enact bipartisan legislation, and the likely resistance among centrist Democrats to immediately pursuing legislation via reconciliation process, which only requires 51 votes in the Senate. It's a big deal, right? Because we're looking for infrastructure bill from Clinton and also from Hillary Clinton and Donald Trump. They both ran on $1 trillion infrastructure bill.
Yep.
But Trump got elected and nothing freaking happened. Nothing. They couldn't decide it because they didn't want, whatever. And it wouldn't have worked either with Hillary. But they both wanted $1 trillion. Maybe you tweak it a little bit. So it's there. But now it doesn't matter. It doesn't matter. Because if they do reconciliation, it's 51 votes. And they have that in the Senate. So they go on to say September be the deadline for the infrastructure bill, though it could pass earlier. So we're not looking at that long, but into 2021, they're saying it's going to be phased out. Like, most projects are phased out where they don't say, you're getting, $20 billion right off the bat in 1 year. Here you go. Where it's like it's $20 billion for a 10, 15-year contract. But again, that's going to result in more money coming into the system. And it's going to be interesting because they say $2 trillion is for infrastructure and $2 trillion is going to be for whatever, which is going to be funny, education or whatever it is. I don't even know, actually.
Well, there's going to be plenty of pork, no doubt. I mean, you know that.
Yeah, of course.
What's wild is some of the offsets and the way they're going to pay for it with the tax hike and things like that. So what people really need to pay attention to is, and I've joked about this, but this is one of the best cliches. When people tell you who they are, listen. And when tax increases are going to be kicked around and coming down the pike, you want to look at companies that have pricing power, because if the corporate rate goes from 21 to 28, okay, math's funny. Don't think 6%. That's 33% increase. Okay, that's a huge jump. If you don't think corporations are going to pass that on to customers, I agree to disagree. And that's going to go through the prices of oil and lumber. Did you see Lennar's housing earnings last night?
Yep.
They're amazing. They're going to do an average $400,000 house, and they're going to do 60-some houses, I think, this year.
Yeah.
And demand's through the roof.
Yeah.
So lumber prices are going to continue to go up, oil, and your prices at, I know you love this, they don't include them, but when you factor in grocery prices and things like that, that's what you want to look for as an investor, getting ahead of that.
Yeah, no, definitely. And just a little bit more into this Goldman report, they're just talking about, however, large numbers are not comparable to the bill Congress just passed for several reasons. Most of these policies will cover several years, and some could be even permanent, but again, over 7 years, which is fine. They said second, the headline price of an infrastructure package is likely to count some ongoing spending. For example, last year's $1.5 trillion House passed infrastructure bill counted nearly $500 billion of highway transit spending towards. But then they go and say, and this is a wild card here. We all know taxes are going to be raised; they have to be raised. But they say third, some of the spending is likely to be offset by tax increases and other spending cuts. And they talk about, expect an increase in the corporate tax rate, which, they ran on, which is fine. Biden ran on, we get it. And increase in the capital gains rate, which, a lot of people are hoping that doesn't happen. You're looking at big risks to this market here. I mean, yes, we're getting more stimulus, but taxes have to be raised. We have an enormous amount of debt. And then, Daniel, we're going to go to, a big risk, which is interest rates, which we saw, right? The 10-year now closing at 1.7%. I don't know if we're there right now. I'm looking at this, which is, around noon today, Wednesday. But it's, we're seeing rates rise, and it is hurting the markets again, and it's a significant risk. But, what are your thoughts on it? Because we did have Wells Fargo come out with a report from today saying that it's going to hit 2.2% this year, and it's going to happen right away.
That's massive.
That is not factored into the stocks. That's not factored into stocks right now. And not only that, they said it's going to be over 3% next year. Again, not factored into stocks. And the amount of debt we have to control that rate.
Yep.
And it's really saying that, hey, you know what? It's saying we're expecting inflation. That's what that rate is saying, and it's crazy, right? But that's a big risk to the market.
Yeah, the market is the market is always right. The reason it's upset about, or we'll see how it reacts to taxes and things like that, price hikes. One more point on that, and the reason for everybody out there that's kind of rolling their eyes or thinking, oh, it's only on the rich, the reason you ought to fight back as individuals and investors on higher taxes, because the economy is the most important thing, and it never stops. The cutoff. You're only raising taxes at 400,000 or a million or 2 million. That number is a one-way number, and it's always going to go down and get closer to the masses. It has to. So that's my last rant on taxes. That's why you should be fearful of that. Interest rates, the FOMC, the Federal Reserve, is meeting today. They're going to do Jerome Powell. This is why we need a soundboard, Frank. I need the Willy Wonka theme song playing while we're doing this. Okay, I want Oompa Loompas. They're St. Patty's Day. They wear green. Anyway, we could have a lot of fun with that. But it'll be interesting to see if he lets the market kind of sell off. It's the Jerome Powell temper tantrum, and it'll be interesting to also see what Secretary Treasury Yellen says afterwards, because there's going to be comments out of the White House. So
yeah, no, definitely, but it will be an interesting meeting. I'm not expecting any surprises other than maybe obviously they're going to say that they're going to raise the inflation target from 2%, which is kind of like 2%. And they're saying well, it's not 2%. They're going to go to 3% or higher because that's what you're going to see. But
you really think? What do you think? I don't think there's any way they let it get to 2.25. I don't think I think they'll have to announce something before that, because if the 10-year goes there, the market's. I would bet the market's got to have to sharply pull back.
It should, because that's the thing. Debt is never a concern. We talked about debt, and I brought this up, I believe, in the past podcast, but debt is not a concern. People have been citing debt as a reason for the market to crash, the world to end, the dollar to disappear since the 60s, 70s, 80s, 90s, all the way up, and we're at all-time highs. And sometimes it came where there was a lot of leverage, and we need to correct itself. In 2008, we got bailed out, and again, with the pandemic and stuff like that. But debt is only a problem when you can't pay it. And right now, with interest rates low, it promotes risk. It promotes you to take out more leverage. This rate going higher with the amount of debt that we have, holy shit, that is not factored into stocks. And I'm telling you, that is the biggest risk by far that can crush the markets. Now, the good news for you is the Fed knows this. They see it coming. It's not like the pandemic. They had no clue. I was reading research reports and breaking them down. I remember in February into early March and saying these guys are crazy. Goldman was like, it's going to be a V-shaped recovery. Next quarter is going to grow. I was like, these guys have no clue what's coming down pipe with COVID. They have no idea. So when the Fed sees this risk, and like 2008, they didn't see the massive leverage behind everything, right? The housing crisis, they didn't really understand. They didn't understand it into mid 2008, where everything was, AIG was involved and all that crap, and everybody got, just filtered through to basically every financial institution. But the Fed sees this. So what could they do is yield curve control, which they did in World War II, which basically caps rates, long-term rates. So now they cap long-term rates and they control short-term rates. If they announce yield curve control, whenever they announce it, because if we go to 2.5%, I'll tell you, just say we're very far away from that, but as quick as it just moved, it is pretty impressive from 1 to 1.7. If it goes to 2.5, we're going to see the market come down a lot. We'll see the market sell off by at least 10%. If the Fed comes out and announces yield curve control, stocks are going to pop by 20% plus. Everything is going to take off. You're going to see massive leverage. Even
with everybody expecting it? I wonder, I don't think he's going to do it today.
They're not, most people, the bond market, a little bit you could say is expecting it, but it's just the timing of it. When are they going to do it? Because now that takes a major, the biggest risk in the market off the table, and it just promotes risk. And you're going to see all risk assets, especially cyclical names, really, really surge. Everybody has money now, right? I know that there's a big discrepancy, and the wealth gap is wider than it's ever been for people who don't own assets compared to people that do. I get it, but they're handing checks to a lot of these people, just handing them checks, and they're also, through unemployment. And now that they're opening up, these people are getting their jobs back. They should. The restaurants are going to hire again. The bars are going to hire again. A lot of companies are going to hire again and bring these employees back with Disney and stuff like that. you will see an absolute explosion if they announce yield curve control, because that is the biggest risk that's on the table right now. And they will announce that if we surge at 2.5 and approach 3%, because they have to.
Yeah,
they have to, because
they're going to
have
to do something. Exactly,
yeah.
They're going to have to do something. I'm with you. Studying that, it was really interesting. I'm still nervously bullish because there's so much liquidity and so much free money and everything sloshing around. But the crazy thing is that you're Jerome Powell. You have to kind of do, they've been foreshadowing everything and being transparent and trying to tell them the market what they're doing, because nobody wants prices to go down. Nobody wants to be in office over anything and have the economy drop or have a stock market lower, no matter what they say. Biden looks at it just as much as Trump does. He just don't tweet about it. But they're playing with investors' emotions of confidence, right? Because if they wait too long and then announce this, and yields are what the market is scaring the hell out of investors, and people think it's out of control, and that will come to show. There's no other time in history where you haven't had huge inflation once you stir it up and try to calm it down. That's just, you can't control the world economy like a puppet in a string, and that's what they're doing. But if you wait too long, maybe you don't get the good reaction, then what do? Now you're going to have to come up with some new QE silliness of whatever. But that's the aggravating part on my side when you're trying to analyze everything, cutting through the big gray areas to look at good companies and solid businesses.
Yeah, I mean, there's going to be sectors that benefit and sectors that don't. We're seeing the rotation of money out of tech. Yes, tech has made a little bit of a rebound here, but into cyclical names that have taken off. You're going to continue to see a rotation of money, not money being pulled, unless, we do see interest rates go higher. Then, we could see money leave the stock market, where I think a lot of bond money has gotten into the stock market, where negative yields were everywhere, and you still had a 1.8% yield on S&P 500, and risk on super low interest rates. So which is great for equities and most assets. So it will be interesting to see how this plays out. Everything's fun right now. Everything's cool because everyone's getting checks and handouts and stuff like that. But I want to see how these businesses actually start performing. It was an easy environment for them. It was made easy for a lot of companies. They were able to cut costs. Now everything is opening back up. But you're going to see some winners and losers, like we saw with cloud. I mean, did you see the numbers from Oracle, and did you see the numbers from IBM with cloud?
Yep.
Oracle was not good at all. IBM was okay. The hybrid cloud that promoting $1 trillion industry that they're really getting it, that they're trying to dominate. But then you saw the numbers from Amazon, from Google, from Microsoft, and what a difference, right? So you're going to see separation between companies but the yield curve control is really, you could just throw a dart and you can make money. And that's going to, again, it's good till it's not good anymore, and it's going to really end up bad. But
who did Tepper, what did he say when they asked him what's going higher? Everything. In response to, was that 2012?
Yeah, 2020, I think it was 2011, where he said, it's going to go higher.
I just love that. Everything.
And I was like, this guy's exactly right.